Sanjeev, good morning. Thank you for joining us. The party continues. I guess this one line captures the market mood at all. The party continues. The point is, how long will it continue?
Pause, yeah. Let it continue. Good for everybody, I guess. What do you want me to say on these things here? I mean, I'm not a forecaster, right? Who can forecast where prices will go or where things will go? As your job is to forecast value, not or rather, I should say, estimate value, not forecast prices.
Okay. So how long do you think the market will continue to disregard value? Let me rephrase my question.
Again, who knows yet? I mean, as of now, you have a bunch of price-sensitive bidders, if you can use that term, in the market. And their view of the market is based on what they have seen in the last 1 month, 3 months, 6 months, 12 months, 36 months of very high returns. So the conclusion a lot of investors have probably drawn from whatever they have observed in the last 3 years, and that's the reality for them, is that you will always make money in the market. You will always make large amounts of money in the market at all price points. And you will make even larger amounts of money at all price points in mid-cap and small-cap stocks. So that is the narrative in the market. That is something which has got embedded in the minds of investors. Again, nothing right or wrong about it. It is just what people have seen in the last few months and years, and that's how they are, reacting. So as of now, that's the expectation that one is going to make large amounts of money at all price points. So that's the narrative which we're dealing with at this point in time.
How should our viewers who are watching the show, who typically have 2 or 3 type of exposures in the market? One is SIP, second is individual stocks, and third is trading. So I'll keep the trading part aside. We'll not discuss that with you. The first two, how should an SIP investor approach this market, and how should somebody who is looking at a bet on individual stocks approach this market, purely from the risk of margin of safety? In your personal views, I mean, everybody has to take the individual call. It is their risk appetite, but in general, as a strategist who's seen many market cycles, what would you say should be a very basic market approach? I cannot hear you, my friend. I think maybe you've gone on mute or audio is down.
No. It's okay. Can you hear me?
Yes, now I can hear you. Maybe it was on mute or something.
Oh, that's okay. What I was saying was that, see, ultimately you have to look at what is the value in any stock on a bottom-up basis. There's no point really talking about the market on a more top-down basis. Look at the fact whether there's sufficient value in the stock compared to the price you're paying. Unfortunately, in India, there's a lot of confusion between price and value. As the famous Warren Buffett keeps on saying, value is what you get, price is what you pay. So ultimately, every individual, every investor has to take a call whether he or she is buying, whether there's sufficient value compared to the price you're paying. So that's the call you have to take, and as long as one believes that, price is okay relative to value, you buy the stock. If you think, the price is way above the value of the stock, you act accordingly. I assume you sell the stock in that case. There is nothing much has changed in terms of how one looks at stocks or how one will invest for the last 50, 100 years, right?
Okay. So let's talk themes and sectors. Up until now, we've heard from 2 IT companies, TCS and HCL Tech. And for the first time, you are seeing the contraction in IT seems to be getting over. Are we looking at a new earnings cycle starting for IT, and is it time to revisit IT after 2-3 years of painful crunch?
Incremental basis looks like things have bottomed out in terms of weak demand that you had seen for the last few quarters. Having said that, keep in mind the fact that over the next few quarters, you're also getting into a period of some slowdown in the US. At least that's what the market seems to be expecting based on the expectations of rate cuts. Presumably, that is based on the fact that the US economy will slow down, etc. What does it mean for demand for IT sector? It is possible that some of the discretionary spending may be pushed out further. And number 2, one of the big sectors for the IT companies is the BFSI sector. that lower interest rates, the profitability of banks should also probably start coming down. Whether they would continue to spend or not, that's a different call altogether. So there are some headwinds emerging, I would say, for the sector. Now, if you look at the valuations, and this is where the challenge comes for any investor at this point in time, is even though the incremental news flow may be positive, a lot of that seems to be already factored in. If you look at valuations of most of the IT stocks, we are well above the pre-COVID levels, and that is really true for most of the market at this point in time. But the problem for the IT sector is that the growth, even though it is going to recover from current weak levels, it is not going to be similar to what we have seen in the last, let's say before the pandemic. So it's just very hard, to get a sense of, what is priced at any point in time. On incremental news flow, the stock must still perform. But given the fact that valuations already factoring that, I would assume, given the fact the multiples are way above what they used to be when the sector was growing much faster, would probably imply that a lot of that good news is already getting priced in.
As we look into the future for next 3 to 4 quarters, where do you think there is scope for earnings surprise, and where do you think there is scope for earnings disappointment? What happens to the stock price is a function of momentum, liquidity. But purely in terms of earnings, where do you think we could be in for better earnings, and where earnings could disappoint?
I don't know whether it's what scope for earnings upgrades, I would say, actually based on whatever I see for analyst assumption to look at our own numbers. Currently, we have 15% growth for the Nifty 50 index. If I exclude BPCL, HPCL, and coal, HPCL, which is part of ONGC, that's why. Because these companies' earnings have become fairly volatile. And last year, their base is actually quite high. That is, the FY 2024 profits of BP and HP were pulled up by very high, both marketing and refining margins. And Coal India had high reported profits based on the change in accounting policy for the OBR provision. So if you exclude that, then we are already building 15% net profit growth in the profits of the Nifty 50 index. If I look at our product coverage universe, about 270 stocks which we cover, it's actually even higher than that. So at this point in time, I don't know whether there is much scope for earnings upgrades. Also keep in mind the fact that in the last few quarters, a lot of earnings growth has come from positive surprises or increase in profitability and margins, not so much as volume growth. And unfortunately, in some sectors, we are still not seeing really meaningful signs of volume recovery. And if for whatever reason you start seeing some sort of competitive pressures emerging in certain sectors, the high levels of profitability that many sectors are enjoying currently, that would also come under some sort of pressure. So in a bad case situation, you could actually have a situation where volumes are not increasing so that in line with whatever the market expectations, and you also have some compression in profitability from very high levels of FY 2024. So I would rule out, scope for positive earnings surprises. But I don't know, probably not much scope for big earning downgrade also, I would say at this point in time.
What are your thoughts on,
There.
Sanjeev, what are your thoughts on the hypothesis of flows, especially from the overseas side, from the FIS side? There have been, lately some signs of cash buying from the FIS side, but largely if you look at the 2-year picture, they have not been around. It's just the rally has been fueled by domestic flows. With rate cut scenario around the corner, do you expect that to change for India?
That's the hope, if you look at 5-year, 10-year time frame, the US market itself has done so well compared to the MSCI emerging market index as an example. A lot of asset allocators and fund managers in the US clearly have very little incentive to look outside the US. With some signs of a slowdown over there, maybe potential dollar weakness and so on and so forth, following the rate cuts as anticipated from September. Hopefully, you start seeing some more interest coming back into emerging markets. That's been the biggest challenge for any emerging market investor. That is the reason also why we have seen such muted flows into India by extension. There's hardly any money going into emerging market funds. Whatever little money that we are seeing coming into India is also largely, I would say, passive flows. In fact, if you dissect the numbers for last year, that is calendar 2023, out of $21 billion, about 10 odd was just passive ETF flows. Another 5 odd billion dollars came from FIIs and IPOs. And as everybody knows, there was a lot of investment by one large fund in the Adani Group last year. So if you actually build in all that, hardly any, I would say, active long only money came into India last year. Unfortunately, the picture is pretty much the same this year also. If you look at the flows into India on a calendar year to date basis, that's somewhere about $1.5 billion. And a lot of that is actually still passive flows. So the challenge still remains the same, I guess, for emerging market investors. It's a combination of A, not much money going into emerging market funds, and B, valuations being obviously on the higher side as far as India is concerned. The feedback I get from a lot of investors is they would like to put more money into India, and I don't think anybody doubts the long-term story of India. The hurdle is just a very high, valuation at this point in time. So that's a challenge. If you are a domestic investor who's used to, sort of seeing the market go up from, let's say, or a stock going up from 40p to 60p, somehow they get adjusted to it. But if you are a investor who wants to buy a stock at 60p, that's a huge sticker price stock for that investor, and obviously, they can't digest that kind of high valuations.
Could you give us an example, just for the benefit of our viewers, that where earning expectations are low and valuations have really gone higher? I'm just trying to establish perhaps a point as a takeaway for our viewers that, okay, this is the reality in the market and this is where earnings are. Maybe with an illustration, maybe with an example, or maybe with a company.
You look at the two-wheeler companies as an example. If you look at their profitability, even though in percentage terms they may not have expanded that much, you look at the EBITDA per unit of these companies, they have gone up significantly in the last 2 years. If I remember correctly, if you look at Eicher as an example, Eicher Motors, the EBITDA per unit used to be somewhere about 35 rupees, 35,000 rupees, I should say, per unit, let's say FY17 to 21, 22. Last 2 years, again, I'm just trying to recall the numbers. Yeah, last year was about 48,000 rupees per unit. So profitability has expanded a lot in sectors. If you look at many of the consumer staples sectors, with the same story. You had companies, taking price aggressively when raw material prices were going up in calendar 21, 22. And companies have more or less kept prices stable when raw material prices have come down. After that, they are again starting to go up. And that has resulted in a big improvement in margins of profitability, whichever way you want to look at for various sectors. And this is more true for automobiles, I would say most of the consumer basket and the capital good companies.
Let's start talking about the new themes in the market. EV, manufacturing. What do you like within these new themes of manufacturing, EV, energy transition? Anything that stands out for you?
Again, you have to always overlay valuations. Everything is good in India when you look at, from a growth angle, right? But the penetration of goods and services is so low in the country. As income levels go up, obviously, volumes will be pretty strong. And for new sectors, new emerging themes, volumes are going to phenomenally high. So I have no doubt in my mind, and we have anyway been big proponents of that. I might have written a big report on energy transition about 2.5 years back, highlighting how, rapid uptake of new energy, that is renewable energy, that's electricity, renewable electricity, as also batteries and EVs will be in the country. So all that will happen probably at a faster rate than what I thought maybe 2, 3 years back. You look at what has happened to either solar PV module prices; they have collapsed completely globally. You look at what is happening to battery prices now; they have come down very, very sharply. So all that should result in, probably penetration levels and growth of these sectors, being much, much higher than whatever we had anticipated even a year back. That is not the issue. The issue is how much do you want to pay for all that growth currently, and that is where the struggle really comes. If you look at many of the renewable energy businesses, let's say solar electricity generation companies, many of them are trading at about 4 times price to book, which is clearly on the higher side at this point in time. If you look at most of the solar electricity generation companies, the ROEs are not that high compared to the cost of equity. So that clearly means you are already a lot of growth in the future is already priced in today. So that is the struggle. If you look at an NTPC power grid, they are now effectively trading at 3 to 3.5 times their regulatory equity book. If you take out the value of investments and cash from the market cap and just compare that with the regulatory equity of these companies. Now, 3.5 times looks very high in the context of the fact that an NTPC will probably make about 17-18% ROE, including incentives, whereas the power grid will make about 15.5% ROE. So that is where the struggle comes. It is not about whether growth will be there or not there. Growth will be there. I don't think anybody disputes that fact. The question is, how much do you want to pay for that? And this is where I struggle with some of the narratives in the market. Many of these things are valued at odd price points, right? I mean, India's GDP growth will be very strong. Yes, nobody disputes that. Earnings growth will be relatively fine. Again, nobody disputes that. There will be a lot of growth in some of the new sectors which you highlighted. Again, nobody disputes that. The problem is these arguments are valued at all price points as far as the stock is concerned, right? So, uh, so what is the what is the analyst community or the investor doing in that case? If the only argument is that that there will be growth, but that cannot be the only argument, right? Somewhere you have to put in the overlay of valuations, and that is where I find things seem to be completely missing in any discussion. There is absolutely no discussion of valuation these days. Only on the narrative, unfortunately.
Well, that's what markets are, Sanjeev. Don't we know that? Fear, greed, ignorance, complacency. I really hope that whenever this entire market cycle ends, it is not a very bad end. That's the unfortunate part. And let's really hope that we're not in a repeat of a typical market boom and a bust cycle. But you never know. Appreciate your time, sir.
If you like this video, then like, share and subscribe to ET Now.